Good morning and welcome to Purpose Driven Finances, where our focus is helping you use your finances to achieve the purpose and plan for your life. And now here's the host of Purpose Driven Finances, Allan Molina with Serwus Capital Management.
Hey, good morning. This is Allan Molina, your host of Purpose Driven Finances, President, Serwus Capital Management. How are you doing this glorious weekend? I love the fall weather, love the cool temperatures, and just enjoying life. Rich, my co-host, great to see you, my friend.
Good morning.
Now I know you know, we jokingly, I bring up jokingly, you know, you go into antique places and auctions and, you know, you love all that. Jokingly. I know you don't like it. Do you like going to orchards? Just curious.
No.
Okay. I'm going to one tomorrow.
Oh, that sounds great. I
don't know what we're going to do, but, you know.
I'm assuming apples.
I guess that's probably what's in. But I tell you one thing, I'm a frugal guy. I liked going to, I don't know the name of it, but in the spring, early summer, whenever it was, when blueberries come out, it was nice getting like pounds and pounds of blueberries, freezing them, saving some money. I like saving some money. But folks, you're not listening to hear about what I'm doing this weekend or hearing about orchards, or you're here for Purpose-Driven Finances, and I thank you for that. I've gotten a lot of calls the past week, past few months, and I appreciate that, but I also want to let you know there's room for more. Give me a call, 434-316-0246. Rich, I know you were we joked that the listeners were riveted about life insurance.
Does it get better?
Oh my! It's so much glory, so much more gloriousness today. We're talking health, disability, and long-term insurance.
Oh yes!
Well, and so the good part.
Strap in, ladies and gentlemen. It's going to be a wild ride.
Woo woo, Mr. Magoo. So what we're going to do is, the first section we're going to talk about what's happening in the economies, the markets, and our portfolios. Second half of the show, we're going to get all three of those in 15 minutes, because realistically, we could probably stretch out, each of those segments, for an hour, but how boring would that be? I mean,
was that a rhetorical question, or am I supposed to answer?
Well, you can answer it, bro. I mean, it would be boring. And I would say, you know what, Rich? I totally agree with you.
It's one of those things, Allan, that, obviously insurance is so important. But, the joke about, who you're going to hang out with at the party, more often than not, it's not the insurance salesman.
Not the insurance guy. Because if he may be a charismatic, fun guy, but you don't want him to be whipping out his business card. Hey, I used to be that guy. Like I was at life group, Sunday school, whatever you call it. And one of our friends, we didn't hang out, but we were cordial. And he was like, "So Allan, what do you think about the economy?" Like, well, you ask a question, I'm going to walk into it. I said, well, it depends on the Chinese New Year. I'm surprised he didn't put his little plate down, getting his little...
He was just making small talk, trying to,
because we're in the same space.
Engage you, and you're ready to get into Chinese New Year.
Yeah.
Fantastic.
Yes, I'm that guy, so I apologize to my friend, sorry about that. I wonder if that's why we don't talk anymore, because I talked about Chinese New Year. But Rich, what I wanted to do is jump into some things, because I had a client stop by, and he's in the QPM 2X. Mm-hmm. And we've talked about the QPM 2X. It's rather volatile. Mm-hmm. What I mean by 2X is it's twice the volatility. So if the S&P 500 goes up 1%, this is 2%, or theoretically it's supposed to be. It's usually realistically 0.75 times 1.75. It's not quite 2%. Mm. But that being said, he says, Allan, what's been going on the past week and a half? All the volatility. And what's interesting is the past two Fridays, because we're taping this on Friday, and so I don't have all the numbers, close of business Friday, but last Friday it was wild and crazy days. He's like, Allan, what's going on? There's a couple things going on in your portfolio. Is first thing, and I've talked about this this is the third week because it has been weighing on the markets. And it's the bankruptcies of First Brands and Tricolor. We've talked about Tricolor. They're the ones who really focused on low credit scores, a lot of illegal aliens, but also, and so they regional used car mainly in California, Texas, some in Florida, Arizona, I believe, but also, and here's what stinks, Rich. I got to sneeze, so hopefully, I don't see a sneeze button, so I will. I'll turn over. I'll duck or something.
Yeah, don't sneeze on me.
Yeah, I know we're close, but not that close. That being said, Tricolor regional used car sales, they went bankrupt because they were pledging their assets to two different banks. Then there's one that I kept on forgetting the name of it. It's called First Brands. They're auto parts, but and FRAM filters and things such as that. But here's what happened. From what I understand, they were fraudulent against Jefferies. And Jefferies is a bank, an investment bank. And so the markets, and when I say the markets, the stock market, the bond market, not really the currency, probably a little bit in the precious metals market, but there was growing uncertainty about what would happen with the larger banks, but also the regional banks, because they were concerned that this was becoming a systematic issue. Now, I know you remember 2007, 8, and 9, the great financial crisis. Bankruptcies occurred generally after the financial credit seized up.
Mm-hmm.
It didn't start with fraud. And these two companies, they're large, and they affected the balance sheets of several banks, but not in a dramatic, oh no, we need a bailout. And so realistically, unless there's a large number of companies that are fraudulent, that are perpetrating fraud, I wouldn't be concerned about it. And so realistically, it's an isolated credit event, not systematic risk. And, the higher interest rates are affecting the balance sheets. But folks, I wouldn't be too concerned with it. Smaller banks, regional banks, and, larger banks over the next week, 2 weeks, they're going to be reporting earnings. If they drop, my guess it's probably going to be a buying opportunity, because these types of things don't really affect. Another buying opportunity has been Trump, the little spat with China, and then some notes that not notes, but interviews or something on Friday. He said basically, hey, it's not sustainable, the high tariff rate. We're going to work it out. Me and Xi are going to hang out in 2 weeks, I think in Singapore or something like that, or Thailand or somewhere in Asia.
Uh-huh.
So it's not going to be a big thing. Any questions about that?
No, that's good to hear.
All right. So the next thing I wanted to point out is I'm going to skip to C, and then we'll go to B.
Yeah, that makes perfect sense.
Exactly. That's the way I roll, Rich. On Friday, Rich, I know you're busy running a company and doing your thing. Gold got beat like a rented mule on Friday. It was down 2% at one time. That's pretty bad for gold. But guess what it did? It went back to the prices it was on Wednesday, Tuesday. So it hurts. Oh, my.
Jeez.
So I tried to find, I was like.
Why? What's causing the volatility in gold?
Man, you're always right there with the questions. I love it. I tried to find. Dude, I searched and searched and searched, because usually there's narratives out there.
Mm-hmm.
There's narratives and narratives. There really wasn't. I even went to mining magazines and mining companies, and basically they were like, it's overbought. It's gone up a whole lot, and interest rates have come off a little bit, and the tariff thing has subsided a little bit. Bankruptcy thing has subsided a little bit. So it's a profit opportunity on a Friday. That's the expected part. And I was going through in investment banks, I don't have targets for investments. I just look at it from a price volume volatility, which we'll get into a little bit in about a minute. What's interesting is there are some companies, and when I say companies, I'm not talking about Goldco or, hey, buy precious metals all the time, but investment banks and research firms like J.P. Morgan and, all of those. There are some companies out there that are calling for $5,000 gold by the end of the year.
Wow.
You say, where is it right now? 4,200? 4,300? That's a big move.
That'd be a big move, yeah.
Mm-hmm. And so the silver and all that will go up. So my suggestion is...
what is that, about a 20%, 18%?
Yeah. Mm-hmm. Mm-hmm.
Crazy.
And so it's expected to rock and roll. So stronger. What's funny is they say stronger U.S. dollar, but right now the correlation between gold and the U.S. dollar is positive, and so one day does not. In yields, I've already talked about it. So any questions about gold? You've asked great questions. I love it.
I'm done. No
All
more
right.
gold.
All right. So quad investing.
All right, one more on gold. How much do you recommend people have in their portfolio?
Here is that, dude, man, you excellent questions today, Rich. It depends on the quad. It depends on the quad.
Okay.
Because some portfolios of our clients, we have 20 to 30% gold or gold-like.
Jeez.
And you say, what do you mean gold or gold-like? Silver, gold, gold and silver miners, large miners, small miners, lithium, palladium, platinum, copper, steel. And so when I say gold or gold-like, we're talking about the precious metals, but also the commercial metals.
Okay.
And so, if you just say gold, probably 10%. The issue that I have with when it's in the QPM2X is they issue K1s. And clients don't like getting K1s from an ETF, so it's just kind of hard. And so what we do is we do miners. But what's interesting is I believe it's Morgan Stanley. I could be incorrect on that. But they came out with a new, instead of the 60-40, they came out with 30% gold, I believe. No, it was 25% gold, 25% bonds, 25% stocks, and then 25% something else.
Mm-hmm.
And so they're trying to shift away from 60-40 to this gold thing. But the problem is I'm expecting that once gold starts rolling over, that they're going to change back. And so your question dovetails right into quad investing. Because, folks, my wife even listens and she says, Allan, I don't know what these quads mean. It's really basically on an XY axis, inflation and growth. I know it's math.
Yeah.
I know.
Are we going to get into sines and cosines and tangents?
Yeah, we could.
Okay.
And you could probably teach me a lot about it.
All right.
Because you probably did a lot more advanced math than I did.
I think that's unlikely.
Guess how many math classes I took in college?
How many?
Guess.
0.
Exactly. I did.
I don't know that I took any either.
I clumped out of all of them. I took a test and they gave me college credit for it.
There you go.
So I didn't take any.
So you didn't need them.
Right. That being said, but now I wish I had have gone, into deeper math. But so let me tell you about the quad investing. Each quad 1, 2, 3, and 4.
Boy, there's something you don't hear very often. I really wish I took more math in school.
I wish I didn't take as much English, But then again, it wouldn't. When I started university, they were like, "Is English your second language?" They put me in remedial English. I'm not joking, bro. I'm not joking. That being said, the quads, inflation, and how the economy is going, and you can do it on a monthly basis or a quarterly basis. And so what ends up happening is quad 1 is Goldilocks, economy improving, inflation going down. Quad 4 is the dumpster fire, economy going down, inflation going down. And so the reason I bring this up is from last Friday to Thursday, the S&P 500, I'm saying closing numbers. The S&P was down 1.93%. Okay?
Mm-hmm.
But for the firm, where we manage according to the quads, was down 0.63. And it's hard to get.
Yeah, so that's almost a percentage and a half better.
Right.
Or a percentage and a third.
It's hard to get apples to apples because I'm painting it with a broad brush. But the benefit there is, and you say, well, Allan, you don't have as many bonds. You have more bonds in there. That's true. But what ends up happening is if you actually manage it according to the quads, I've had 50% stock, 50% bond portfolios on a probably 75% of the time outperform the S&P 500. If the S&P 500 is up 0.4, it'll be up 0.5. And the reason being is it goes to where the strength is if you manage according to the quads. And you say, well, how it's been back tested, the performance of various styles of investment, but also asset classes going back 15, 20 years. So we have a very high probability of where to go in the upcoming quad. And so the advantage is investing in with a quad system, it makes the portfolios dynamic. Not, let's buy these 10 mutual funds in 2015 and we'll change them if the manager changes in 2035. And so what happens is you change it because you would think that managers change it, but a lot of the problems is if you are value based and you value a company according to what you think the PE ratio should be. Did you know in bubbles what happens to stocks? They get more expensive. And so a lot of value managers won't invest in them, but they'll run for another 2, 3, 4, 5 years. But you know what happens when a significant deep recession happens? Stocks become cheaper. And so let's say a stock goes to a 9 PE or a 8 PE. And you're like,
that's price to earnings ratio.
Yep. Thank you. But
for those playing along at home.
Right. But if the market continues tanking and it goes down to 6, that's a significant drop in price from a 9 to a 6. So realistically, the quad investing enables you to forecast where the economy is, where it's going, but also to go to those best places in the portfolio. And we only have like 10 minutes left, 11 minutes left. So that's exciting, Rich.
That is exciting.
So we have 30 seconds of folks. Give me a call, 434-316-0246. Come back, and we're going to talk about health, disability, and long-term care insurance in 11 minutes.
Words of wisdom from the woodsman. Life rule number 9. Look for the grift. Our sin nature inherently drives each of us to self-worship and self-preservation. Quoting Proverbs 26:24, the evil-minded will disguise themselves with their lips, but in their hearts they harbor deceit. I'm Tommy the Woodsman. Selflessness, integrity, and authenticity are my priorities. If you want a tree service provider who is going to give you an honest assessment and not try to pull one over on you, then submit a request for an estimate at IHaveASawForThat.com.
And now, back to Purpose-Driven Finances. Here's Allan Molina with Serwus Capital Management.
Hey, good morning again. Allan Molina, your host, Purpose-Driven Finances, president of Serwus Capital Management. You know, Rich, you ever done speed dating?
No.
Neither have I.
No.
Because I got married really young. It would be highly inappropriate if I did speed dating now. But just pretend that you know about speed dating or you've heard about it. We're going to do speed insurance because we have roughly 3 minutes and 33 seconds per section. So we get to fly. We get to fly through this. So let's talk about health, because we're talking about know your number. Know your number, and let's talk about health insurance. Now, Rich, I don't know about you, but Obamacare totally destroyed our insurance.
Mm-hmm.
We were paying like $800, $900 a month, and we changed to an alternative health care because it got up to like $2,500, $2,600, $2,800 a month.
It's crazy.
And we've been blessed with good health. We go to telehealth probably once or twice a year, and that's been the way it has been for the past 10 years. So thankful for that. But that being said, they look at their insurance, their health insurance, and they want to know total costs. A lot of times they don't even look at total cost. And so the easiest way to figure out what your number is for your health insurance is you add up these three things: your premium, your deductible, and your out-of-pocket maximum. And aren't you happy I have a sample right there for us?
Yes, I'm glad to hear that.
I am too. I don't want to figure that out of my head. So the premium, let's say it's $1,200 a month.
Mm-hmm.
That's $14,400 a year. Your deductible is $5,000. Your out-of-pocket is $3,000. So your total expense is $22,400.
Well, and that's the most you could pay.
Right.
Okay.
Yeah, that's
So
the
it's
most.
not it's not really your expense. It's your, what's a better word for it? Exposure, maybe?
Mm-hmm. That's your exposure. Yeah, it's exactly. Why are you turning red, bro?
Just trying to help, Allan. Because, I mean, if you're healthy, then you're not going to pay the deductible, the out-of-pocket or whatever.
Right.
You just
Pay $14,400.
You just
for
pay
nothing.
for nothing.
For nothing.
Yeah.
Because I calculated it, and it's almost the amount of money. Because what we do is we have like a MediShare. We use Samaritan Ministries
Mm-hmm.
because what happens is everybody pays, and it works really well. And Pam reminded me that she had surgery and it was totally paid for through that. And so I've had clients. They were the ones who actually turned me on to it. They had an at-risk pregnancy of $50,000, totally paid for.
Wow.
And it really helped. So what you need to do is when you're looking and budgeting for your insurance, look at your maximum exposure and make sure that you're covered in all the ways you need to. And aren't you glad we're not going to talk about being healthy? Not going to go there. Not going to go there. We'll save that for another time, another place.
Sounds good.
Disability insurance. This is one of those things that realistically we could spend a minute or two on,
Mm-hmm.
simply because this is like the fifth tier insurance that people ever think about. And realistically, what they do is they get the disability insurance usually through a work, not. I wonder.
That's it for example, and I know we don't, make recommendations, but the one everyone knows is Aflac.
Right.
Right.
Exactly. I wanted to make the noise, but I just couldn't do
Go
it.
ahead.
Aflac. I can't do it. I've had Aflac, and it's nice, but if you don't ever go to the doctor again,
Yep.
it's frustrating. And so realistically, disability insurance, what it does is it replaces income if you can't work due to illness or injury. And realistically, my notes say it's your income is the greatest asset, but sometimes that's not the case. Sometimes I have friends who they're trust fund babies. The trust fund is the greatest asset. So realistically, you need to look at, if you get disabled and is it long term or short term? So Aflac is another good thing. So we sped through those pretty quick. And folks, if you have questions about these, I'm willing to sit down and help you go through the minutia. And if I don't know the deep details of these platforms or programs, what we'll do is we'll call in an expert, and because there's experts who sell health insurance and disability, and it's very important that you're covered and make sure you're properly taken care of. Now, Rich, let's talk about long-term care insurance. I was listening to another show that WLNI has. Was it At the Table?
Uh-huh.
With Vicky Runk? Is that the name of the show?
Yes.
At the Table?
Yes.
And they were talking
Around the table.
Around the table.
Yeah.
They do a great job. They had the Law Dog a few weeks ago, but they do a good job, and they're nice people. But I was sitting, I was listening to them, and they were talking that long-term care insurance is up to $10,000-$12,000 a month here in Virginia. I'm not debating that. They're actually in the industry. I've heard that numbers are a little bit lower than that,
Mm-hmm.
but it probably is determined on the quality of the facility that you use. Because you can probably get a facility for $6,000 a month, but sometimes
That ain't where you want to put your mom or dad.
Exactly. And so you want to make sure you're taken care of. And so, the notes, it's $65,000 to $100,000 a year. That's probably a little light, but also you can get long-term care for in-home. A lot of people don't realize that. And in long-term care insurance, there's all kinds of numbers that go with long-term care insurance. One of them is inflation protection. And this is where it gets really confusing. And they have inflation protection that is simple. They have inflation that is compound. And then they have inflation that is none. Now, simple is just, 3%, 5%. They have different levels of inflation. And what it does is if it's $20,000, let's say it's $10,000 a month. And if they have 5% inflation, that's $500 a month. And what they do is every year they add 5%, but it's not 5% on the 10,500, it's 5% on the 10,000.
Okay.
Compound inflation is 5% on the 10,500.
500, yeah.
And then the benefit of that is if you have the policy for 15 years, you've really increased the
Your
level.
coverage, yeah.
And one thing that people don't realize is health insurance inflation runs about 6 or 7%, much higher than traditional CPI insurance and things such as that. So you need to make sure of that. Also, Rich, I don't know if you knew this, but they have life insurance that can actually be a quasi long-term care policy. The insurance I just purchased, it enabled me to, if long-term care comes into play, that I can turn on and basically cash out at no additional cost and things such as that. So it's a huge benefit.
One of the other things, if I'm remembering correctly, is, for people who might not qualify for some type of insurance, in some cases, I think there are annuities, right, that could, also help save that.
Right.
And I know most financial advisors aren't big on annuities because they're very high in fees and there are a lot of different reasons. But, there are certain circumstances, right?
I totally agree with you, Rich. I've sold annuities to people who couldn't get health insurance, and they wanted it guaranteed. I remember it was a 7% ING. They don't make it anymore because the actuary messed up. But I totally agree with you. There used to be Money Guide or Money Guard.
Yeah.
Money Guard. It was a savings, a life insurance, and a
long-term care.
Long-term care.
Yeah.
So there's a lot of things that can help because realistically, it's all about making sure your family's taken care of. Now, one thing I wanted to mention about long-term care is it also goes into the number of years it actually goes into effect. Most of them have the period of time where you have to wait 90 or 180 days. But a lot of times they go for 2 years, 3 years, 4 years, 5 years, or unlimited. So all of these affect the price. One thing I wanted to mention, Rich, is if you have dementia or memory issues, you generally can't get long-term care, but you can probably get life insurance. If you have heart issues, you can't get life insurance, but you can probably get long-term care. A little messed up there.
Crazy.
It is. So, folks, remember, it's not only the financial impact, but it's also the emotional impact of making sure your loved ones are taken care of and taken care of properly, and as you're helping and serving them. I want you to give me a call at 434-316-0246. I'm here to help you, to serve you, and to help you achieve the purpose and plan for your life. And I know that there's so many questions you have. Let's do a retirement analysis or education planning. There's so much we can do. Hope you have a blessed weekend, and I will talk to you next week.
Returns for illustrative purpose. This is not a suggestion to buy, sell, or use a platform. Only will a suggestion occur after a meeting to determine goals, risk tolerance, and time horizons. Investments involve risks and no guarantee of future results.